Millennial Money. How Young Investors Can Build a Fortune by Patrick O'Shaughnessy is a practical guide to investing that focuses on helping young people build wealth through strategic investment practices. The book offers insights into long-term financial success by addressing common investment myths, explaining market cycles, and providing a clear path toward financial independence. Here's a detailed summary of the key concepts and insights. Chapter 1. Why Millennials Should Start Investing Early. O'Shaughnessy begins by emphasizing the importance of starting early. He explains the power of compounding returns, which allows investors to turn small, early investments into substantial wealth over time. Millennials have a distinct advantage with time on their side, meaning even modest investments can grow significantly if allowed to accumulate for decades. Starting early also allows young investors to take on more risk, which can lead to higher returns. Chapter 2. Understanding the Basics of Investing. This chapter breaks down essential investment concepts and terminology for beginners, including stocks, bonds, mutual funds, and exchange-traded funds, ETFs. O'Shaughnessy introduces the idea of risk tolerance, explaining that young investors typically have a higher tolerance for risk due to their longer investment horizon. He encourages millennials to focus on equities, stocks, rather than more conservative investments like bonds, as stocks tend to provide greater returns over the long term. Chapter 3. Common Myths About Investing. O'Shaughnessy debunks several myths that prevent people from investing, such as the idea that only wealthy people should invest or that the stock market is too risky. He provides evidence that, despite market volatility, long-term investing in a diversified portfolio has proven to be a successful wealth-building strategy. Another myth he challenges is that people should wait until they have substantial money to invest. Instead, he suggests starting with whatever amount is possible and adding more gradually. Chapter 4. The Importance of a Long-Term Perspective. The author stresses the significance of patience and avoiding short-term market fluctuations. He explains that the stock market has cycles, including bull or rising and bear or declining markets. By focusing on the long term, investors can ride out downturns and benefit from market recoveries. O'Shaughnessy also warns against emotional decision-making, as it can lead to poor choices, such as selling in a market dip or jumping on hot stock trends. Chapter 5. Building a Diversified Portfolio. O'Shaughnessy introduces the concept of diversification, which involves spreading investments across different asset classes to reduce risk. He explains that by holding various types of investments, such as stocks in different industries, bonds, and real estate, investors can safeguard themselves against significant losses. He advises millennials to focus on broad market index funds, which offer diversification across an entire market and have lower fees than actively managed funds. Chapter 6. The Role of Costs and Fees. In this chapter, O'Shaughnessy highlights the importance of minimizing costs to maximize returns. He discusses common investment fees, including management fees for mutual funds and trading fees for individual stocks. Over time, these fees can significantly erode returns, which is why he recommends low-cost index funds and ETFs. For young investors, minimizing costs can compound into substantial savings over time. Chapter 7. Active versus passive investing. O'Shaughnessy explains the differences between active and passive investing. Active investing involves picking stocks or funds that a manager believes will outperform the market, but it comes with higher fees and is rarely successful over the long term. Passive investing, such as buying and holding index funds, aims to match market returns with lower fees. He strongly advocates for passive investing as a proven strategy for millennials to grow wealth. Chapter 8. The Value of Index Funds. Building on the discussion of passive investing, O'Shaughnessy makes a compelling case for index funds as the backbone of a young investor's portfolio. Index funds track the performance of a market index, such as the S&P 500, providing broad exposure to the stock market at a low cost. Because they require minimal management, index funds are also tax efficient. He suggests that millennials build their portfolios primarily around these funds for steady growth. Chapter 9. The Benefits of Dollar Cost Averaging. O'Shaughnessy introduces dollar cost averaging, or DCA, as a method to invest gradually over time. This strategy involves consistently investing a fixed amount, regardless of market conditions. DCA reduces the impact of volatility as it spreads purchases across market highs and lows. This disciplined approach also minimizes emotional investing, helping investors avoid panic buying or selling. Chapter 10. Automating Investments for Success. Automation is a recurring theme in O'Shaughnessy's advice, as it removes the need for decision-making and encourages consistency. He suggests setting up automatic transfers from a bank account to investment accounts each month. This approach reduces the temptation to spend rather than invest and ensures that millennials stay on track with their financial goals. Chapter 11. Understanding and Managing Risk. Risk is inevitable in investing, but understanding and managing it is crucial for success. O'Shaughnessy explains different types of risks, such as market risk, fluctuations in stock prices, and inflation risk, which is the reduction in purchasing power over time. He recommends that millennials manage risk by diversifying their portfolios and staying committed to a long-term plan. He also stresses that the biggest risk for millennials is avoiding investment altogether due to fear. Chapter 12. How Behavioral Biases Impact Investing. O'Shaughnessy delves into behavioral finance and the psychological biases that affect decision-making. Common biases include overconfidence, loss aversion, and recency bias, which can lead to poor decision-making in volatile markets. He advises millennials to recognize these biases so they can make rational decisions based on logic rather than emotion. Chapter 13. Taxes and Retirement Accounts. This chapter covers the basics of tax-advantaged retirement accounts, such as IRAs and 401ks in the United States, which offer tax benefits that can significantly boost investment returns. O'Shaughnessy encourages millennials to take full advantage of employer-sponsored retirement plans and any matching contributions, as they offer free money and reduce taxable income. He also explains the differences between traditional and Roth accounts and how each one can benefit investors at different life stages. Chapter 14. The Power of Financial Independence. In this final chapter, O'Shaughnessy focuses on financial independence, which allows people to live comfortably without relying on employment. He encourages millennials to establish a clear financial goal and work toward it by making smart investment choices, managing spending, and continuously learning. He sees financial independence not just as a way to retire, but as a pathway to freedom, enabling millennials to pursue their passions without financial constraints. Conclusion: The Roadmap to Building Wealth as a Millennial. O'Shaughnessy's book concludes with a call to action for millennials to take charge of their financial future. By following the principles outlined, starting early, investing in index funds, minimizing fees, and maintaining a long-term perspective, millennials can achieve financial security and even wealth. The author emphasizes that wealth building isn't a matter of luck or timing, but discipline, knowledge, and a commitment to a proven strategy. Key takeaways: Start early. Take advantage of compounding returns by beginning to invest as soon as possible. Invest consistently. Use dollar-cost averaging to steadily build wealth and mitigate market volatility. Focus on low-cost, passive investing. Index funds and ETFs are generally better choices than high-cost active funds. Automate investments. Set up automatic investments to ensure consistency and minimize emotional decisions. Minimize fees, avoid high-fee funds and trading costs to maximize long-term returns. Embrace financial independence. Aim for financial freedom by establishing clear goals, minimizing unnecessary expenses, and investing wisely.